Did you know Indian investors have been blocked from getting easy exposure to the S&P 500 and Nasdaq through many domestic mutual funds? Well, today in this explainer, we're diving into exactly why that happened, and more importantly, the solution most investors still don't know about. We're talking about a completely legal, structured workaround that unlocks global markets. Now, you might be thinking, wait, I'm blocked? Yes, if you've tried to get easy exposure to U.S. indices through your regular domestic mutual funds lately, you've probably hit a brick wall. So let's look at why that is. It all goes back to a hard cap. A few years ago, Indian mutual funds collectively hit their overseas investment ceiling. And that ceiling? Roughly $7 billion US. The second they hit that limit, the doors just slammed shut. Overnight, over 70 international mutual fund schemes had to freeze fresh subscriptions or heavily restrict inflows. And that created a massive headache for investors, because suddenly you couldn't easily put fresh money into global tech giants. We're talking Apple, Microsoft, Nvidia, Amazon, Alphabet, the heavy hitters. Basically, you were locked out of the global growth story. So here's our roadmap for today. We'll quickly cover the $7 million bottleneck, then enter GIF City, how outbound funds actually work, tax rules and traps, the manual SIP warning, and finally, the final verdict. All right, Section 1, the $7 billion bottleneck. Moving right along to Section 2. Enter Gift City, our offshore workaround. So what exactly is the alternative here? It's GIFT City. That stands for Gujarat International Finance Tech City. Now, physically, it's right there in Gujarat, but legally, it's a totally different ballgame. It operates as a separate global financial center right on Indian soil. It's run by a unified regulator called the IFSCA, the International Financial Services Centers Authority, instead of SEBI, which regulates standard domestic mutual funds. Because of this totally separate structure, investors can access U.S.-focused products without being held back by those same domestic mutual fund limits. This really highlights the contrast between these two totally different worlds. On one side, you have the restricted domestic route, regulated by SEBI, transacted in rupees, and hitting that massive $7 billion brick wall. But then, look at the other side, the liberalized offshore framework of Gift City. It's regulated by IFSCA, transactions are in US dollars, and it uses your own personal remittance limits instead of a nationwide cap. Section 3, how outbound funds actually work. Let's walk through exactly how the money flows. Step 1, the cash leaves your regular domestic Indian bank account in rupees. Step 2, you use the RBI's liberalized remittance scheme, commonly known as LRS. This lets resident Indians send up to $250,000 US per financial year. So your rupees are converted to US dollars through the Gift City banking framework. And finally, step 3, those shiny new US dollars go straight into the Gift City index fund of your choice. Now, you might think this is only for the ultra-wealthy. Not anymore. Many Gift City funds now allow investments starting at just $500 US. Though keep in mind, some funds will ask for an initial minimum of $5,000, which is roughly 4.3 lakh rupees. And there's a really smart reason for that. It keeps your first investment under the 10 lakh rupee threshold, which helps you dodge immediate tax collected at source or TCS deductions on that outward transfer. But after that first hurdle, you can usually just top up in increments of $500. All right, Section 4, tax rules and traps. You definitely want to navigate this part with caution. What's super interesting here is how the tax implications shift completely depending on your residency status. For resident Indians using these outbound funds, you'll often encounter something called scheme-level taxation. This is actually pretty convenient. It means the net asset value, or NAV, is already post-tax. The fund itself calculates the tax on any internal gains or dividends and pays it to the government using its own PAN. So when you eventually redeem your units, the money you get is completely net of all Indian taxes. Just one big catch. You absolutely 100% must declare it as a foreign asset in Schedule FA on your tax return. Don't forget that. Let's break down who really benefits the most. As we just saw, a resident Indian gets that nice post-tax NAV. But if you're a UAE-based non-resident Indian, wow, it is pure gold. Capital gains are entirely exempt from Indian tax under Section 10(4)D. That means zero tax on both sides. But, and this is a huge but, if you are a U.S. person, beware. The IRS views these funds as passive foreign investment companies, or PFICs. And even though India charges zero tax, the U.S. will slap you with severely punitive rates. So yeah, always consult a tax professional before making a move. Section 5, the manual SIP warning. Okay, so before you jump in, there is one major limitation you really need to know about. It usually brings up the biggest question investors have. Can I just set this and forget it? Can I automate a monthly SIP into the S&P 500? Well, as of 2026, the answer is unfortunately no. Automated SIPs are generally just not available yet for Gift City mutual funds. Unlike your regular domestic mutual funds where the money just auto-deducts, here you usually need to make your investments manually. Fund houses are definitely working on fixing this, but for the time being, you have to physically log in, initiate the transfer, and make the investment every single time if you want to top up. Which brings us to Section 6, the final verdict. Is it actually worth it? Here's the deal. If your ultimate goal is securing long-term exposure to the S&P 500 or the Nasdaq 100, Gift City might currently be one of the absolute most practical, legal routes available to bypass that locked domestic market. You're getting professional management, a highly regulated structure, and you get to hold your assets in US dollars. You just need to make absolutely sure you understand the tax rules, the currency dynamics, and the operational quirks before investing. So the question is, are you willing to manage your investments manually and navigate these unique rules to unlock those global markets? Take a look at your portfolio, weigh the pros and cons, and decide if it's time to take your investments global. Thanks for joining me for this explainer today. Keep learning, and we'll see you next time.